Hello everybody, my name is Shipra Singh and I welcome you all to this new video on basic accounting journal entries interview questions from Career Right. The topics that we are going to cover today are partnership and not-for-profit organizations that are usually asked at the interviews. In our previous video on basic accounting interview questions, we saw some important questions on topics like bookkeeping, journal, ledger, subsidiary books, bank reconciliation statement, rectification of errors, final accounts, etc. Now see, the questions that we are going to see today may sound basic at first glance to you, but the real challenge is in how clearly and confidently you explain them, especially during the interviews, where why behind the entry matters more than the entry itself. So in today's video, we'll cover those slightly tricky yet commonly asked concepts like not-for-profit organization adjustments and partnership journal entries that are explained in very simple words. Whether you are a fresh graduate or an experienced accountant, this video is going to be helpful to all of you to prepare for your interview. Make sure that you watch it completely without skipping any parts of it. And if you find the video useful, don't forget to like, share and subscribe for more interview preparation tips from Career Right. Ready? Fantastic. Let's start. Question number 1. Tell us something about not-for-profit concerns from accounting point of view. Okay, so as the name suggests, not-for-profit concerns come into existence to give service to people. Their purpose is not to make profit. For example, charitable hospitals, schools, colleges, sports clubs, then your religious concerns, libraries, etc. The way they maintain their books of accounts is different from other concerns. Now, the question that arises here is, what's the difference? For example, since they don't earn profit, they don't prepare profit and loss account. Instead, they prepare income and expenditure account. Similarly, they don't prepare trial balance. They prepare receipts and payment accounts. The final accounts in this case consist of income and expenditure account and balance sheet. The members of these concerns can't take dividend. So these are the major differences that you find in case of not-for-profit concerns from the point of view of accounting. Now, the follow-up question to this could be, how do these not-for-profit concerns collect their money? So see, mostly these concerns deal with public money. The money they collect comes in the form of subscriptions, donations, grants, entrance fees, etc. Okay? Now, we just saw a while back that these not-for-profit concerns don't prepare trial balance. They prepare receipts and payment account. So, your next question could be about that. The question could be, tell us a bit about receipts and payments account. To answer this question, you can say, receipts and payments account is a real account. It is similar to a cash book, quite like a summary of all your cash and bank transactions during a given period. You can see the opening and closing balances of cash and bank account in this account, and it works as the basis for the preparation of final accounts. To add more weight to your answer, you can further add that if there's any income receivable or amount payable, you won't find those records here. Okay? Now see, there are two common types of receipts in the case of not-for-profit concerns. They are capital receipts and revenue receipts. Your next question could be about them. And the question could be, what is the difference between capital receipts and revenue receipts? So see, the main point of difference between the two is capital receipts are non-recurring in nature. They do not form a part of regular flow of income for the concern. For example, if you get a donation to construct an additional floor in your school building, life membership fees, sales proceeds from fixed assets, sports tournament, what are all these? All of these are capital receipts because they are non-recurring in nature. These capital receipts are either added to the capital fund or separately shown on liabilities side of the balance sheet. Now coming to the revenue receipts. All the receipts that are recurring in nature and show regular flow of income are revenue receipts. As simple as that. For example, your subscription fees, locker rent, interest received. What are all these? All of these are revenue receipts. Okay, now let's move on to the payments part. The question here could be, what is the difference between capital expenditure and revenue expenditure? So now this is quite similar to the previous question where we saw receipts. And if you have understood that, this one is going to be pretty easy for you. So the expenses that are non-recurring in nature are considered to be capital expenditures. You receive their benefits for a very long time. For example, if you purchase a land, machinery, furniture or any other such things, it is a capital expense. You show them on the assets side in your balance sheet and their balances are carried forward to the next accounting period also. On the other hand, any expenses that are recurring in nature are treated as revenue expenses. For example, your salaries, taxes, premiums, insurance that you have to pay. What are all these? All of these are revenue expenses. Okay, now the next important account that we talked about in the case of not-for-profit concerns was income and expenditure account. Be prepared to discuss this also during the interview. And the question based on this could be, tell us a bit about income and expenditure account. So see, income and expenditure account is a nominal account. It records only revenue receipts and expenses of current year. This account is similar to profit and loss account and it is prepared to find out the surplus or deficit which is accompanied by a balance sheet. There is no opening balance in this account. The surplus or deficit you find is transferred to the capital fund. All cash and non-cash items pertaining to the current period are recorded in this account. For example, the salaries that have been paid or outstanding, bad debts, depreciation on fixed assets, everything is recorded here. Okay, now pay attention to question number 7 that I am bringing before you. This is very simple but is asked just to trick you. The question is, do the balance sheets of trading and non-trading concerns differ in any way? Now, the answer is no. They are similar. They don't differ in any way. Moving on to question number 8 with this. What do you know about implied adjustment? Now see, sometimes in receipts and payments account, you have some information available regarding a certain item rather than the actual figures. But you have to know that these figures are going to have an impact on your accounts. So you need to make the calculations, derive this figure and post it to the account. The adjustments you make on the basis of this additional information are called as implied adjustment, hidden adjustments. For example, if you are just told that an FD was opened on so and so date at X rate of interest, while preparing your account, you will need to make the calculation of the interest received before you can post it to your income and receipt account. What is this? This is implied adjustment because this figure of interest is not provided to you explicitly. You are calculating it and then posting it to the account. Okay, let's move on. Okay, now question number 9 is very important. Pay attention. What is accrued income? What is its effect on the accounts of not-for-profit concerns? So the income which is earned during the year but not has been received till now during the year is termed as accrued income or outstanding income. For example, if a not-for-profit organization earns interest on fixed deposits for the year but hasn't received them yet, that interest is considered to be accrued income. Simple till here, all of us know this. Now coming to its effects on the accounts of NPO. So the accrued income is added in the concerned income on the income side of the income and expenditure account. This ensures that all the income that has been earned during the year is accounted for, regardless of whether it has been received or not till now. The second important thing is it is shown on the assets side of the balance sheet under current assets because it represents an amount that will be received in the future. So this was about outstanding income, but there could also be a case of income received in advance and there could be a question on that also. And our question number 10 is about that income that has been received in advance. And the question is, suppose if you receive the income in advance, what would be its effect on the accounts of an NPO? So for those of you who don't know this, income received in advance is also called as unearned income or pre-received income. It refers to the income that has been received during the current financial year but pertains to the next financial year and is not actually earned yet. This means you still have to do your work for this money that has already been paid to you. For example, an NPO may receive the subscription fees for the next year in advance. Since this amount is not earned yet, it cannot be considered as current year income. So how do you treat it here? This amount of income that is received in advance is deducted from the concerned income in income side of the income expense account. This is to ensure that only the income that has been earned during the year is recorded, and it is shown on the liabilities side of the balance sheet. Why? Because the amount belongs to the next accounting period and might have to be refunded if the services are not provided. That is why it is a liability. So see, these two questions, 9 and 10, both of them are very, very important. Pay attention. If need be, you can replay this much part of the video to ensure that you have got them right. But make sure that you are pretty clear with them. Fantastic. Let's move on to question number 11 with this. How would you treat the life membership fees? Now see, life membership fees is the amount that is paid by the members only once for a lifetime membership instead of annual subscriptions. Now, since this is a non-recurring income, it should not be treated as regular income in the income expenditure account. So what's the correct treatment in that case? The correct treatment is, first of all, it is not recorded in the income expenditure account because it is a capital receipt, not an annual income. Secondly, it is shown on the liability side of the balance sheet, usually under general fund or capital fund or a separate life membership fund, because you have to deliver services against it in the future. You have not delivered them yet. Okay? Pretty simple and easy. If need be, you can replay this much part of the video and watch the question again. Moving on to another important question. Question number 12. Suppose an NPO wants to sell out its old assets like its furniture. How would you treat this? Now see, the answer to this question lies in the basics that we have just seen. So when an NPO or not-for-profit organization sells an old asset like its furniture, the transaction is treated as a capital receipt. Why is this so? This is so because it is not a part of the NPO's regular activities, right? Next, when you sell this furniture, there will be either loss or profit, but we know that there is no P&L account here in the case of NPOs. So what do? The profit or loss here is recorded in the income and expenditure account. If there's a profit on the sale, it is shown on the income side. If there's a loss on the sale, it is shown on the expenditure side. But mind you, the actual sale amount is not recorded in the income expenditure account because selling fixed assets is not a regular income generating activity for these not-for-profit organizations. What you record here is the profit or loss on the transaction only. Okay, now the questions on partnership are also quite common in the interviews. This could be reconstitution of partnership, dissolution of partnership, or other such things, and the journal entries associated with them. And those type of questions are very, very common with the interviews. Okay, let's see some of the important ones here. So the first question here is, what do you mean by capital in terms of partnership accounts? What is the difference between fixed and fluctuating capital method? This is the most basic question that you find on this topic, but it is an important question. Pay attention because it sets the foundation for the topic. So see, the amount that a partner brings in to manage the business activities is called as capital. It can be in the form of cash or kind. Now each partner here would have a capital account to record their investment in the business. This account can be maintained as per fixed capital method or fluctuating capital method. In case of fixed capital method, the capital remains fixed except when additional capital is introduced or withdrawn permanently. There are two separate accounts that are maintained in this system. The first one is capital account that shows the permanent capital balance. And the second one is current account that records all the transactions like drawings, interest on capital, share of profit or loss, etc. Now, let's move on to fluctuating capital method. In this case, a single capital account is maintained for each partner. All the transactions such as interest on capital, drawings, profit share, etc. are all directly adjusted in this account only. There's no separate current account in this case. The balance keeps changing because there are continuous additions and deductions happening here. So if you see, fixed accounts method is suitable when partners don't frequently change their capital and want to track their profit or loss separately. Otherwise, fluctuating capital accounts method works better. Okay, moving on to the next question. Suppose a new partner joins your partnership firm with some capital or assets. How would the journal entry for this be made? Now see, this is pretty simple. When a new partner brings in cash towards his capital, the journal entry would look something like this. And when the new partner brings in certain assets towards his capital, the journal entry would look like this. So you see, the entry here suggests that the firm is now receiving an asset or cash with this contribution. So the cash or assets increase. So we debit. The partner's capital account here is credited because he's contributing this asset or cash to the firm. He's gaining ownership in the firm with this, and the firm now owes him this amount. That is why this entry. Clear? Fantastic. Okay, now whenever there's a reconstitution of partnership, the new profit sharing ratios also come into picture. This ratio is used for writing off the goodwill and also to make the capital adjustments, etc. You'll find that many a times the interviewers ask us practical interview questions also on these type of concepts. So one such question for you could be, suppose two partners X and Y currently share profits and losses in the ratio of 2:3. A new partner Z joins for 1/4 share in the future profit. What will be the new profit sharing ratios of X, Y and Z? Okay, so first of all, just go by whatever I'm saying here. By the time we end this question, you'll get everything. So the first thing to pay attention to is the formula that is used to calculate this new ratio is here, as written in this box here. Okay, so the formula that we use is 1 minus share of new partner is equal to balance of 1, and when you want to calculate your new ratio, you multiply your old ratio with the balance of 1. Okay, this is the formula that we are going to use. Now let's apply this formula in this case. Let's try to calculate balance of 1 first. So the balance of 1 is equal to 1 minus share of new partner. What is the share of new partner here? It is equal to 1/4. Okay, so the value here will be 1 minus 1/4, and that will come out to be 3/4. Now, if we want to calculate the new ratio of X, partner X, what would it be? That is equal to old ratio into balance of 1. What is the old ratio? We see that the old ratio here is 2:3. Okay, which means out of the 5 parts, X's share is 2. So 2/5. So 2/5 is his old ratio. Let us multiply it by balance of 1. Multiplied by 3/4. That is equal to 6/20. Y is equal to similarly 3/5 into 3/4. That is equal to 9/20. Okay. Now what would be the Z's ratio? It is 1/4. So if I want to write 1/4, making my denominator 20, what would it come to? It will be 5/20. Why am I doing this? I am doing this because I want to get all the denominators same. Right? So I have multiplied 1/4 by 5 on top and 5 in the denominator. Okay. So what is my new profit sharing ratio in this case? X is to Y is to Z. It is 6 is to 9 is to 5. This is very, very simple. If need be, you can either replay this much part of the video or just pause the screen here and take a good look at it. There is nothing difficult here. You can easily do it. Okay, so now our question number 16 is, what is sacrifice ratio? So see, when a new partner is admitted, old partners will have to sacrifice their share of profit so that the new partner's share can be accommodated. That's obvious, right? So the ratio in which the old partners sacrifice their share is called as sacrifice ratio. If you see it mathematically, old ratio minus new ratio is equal to sacrifice ratio. This is the formula. Let's go back to the previous question. Question number 15. We saw that X and Y's old ratio was 2:3 in that case, and on addition of Z, the new ratio was 6:9:5. What would be the sacrifice ratio of X and Y in this case? It would simply be, for X, 2/5 minus 6/20 is equal to 8/20. And for Y, it will be 3/20. This is a simple mathematical calculation in which you are putting up the value of old ratio and the new ratio, and you are finding the new values, the sacrifice ratio for X and Y. This is pretty simple application of simple mathematics, which I trust all of you will be able to do. So the sacrifice ratio of X and Y in this case would be 8:3. Question number 17. What do you mean by new ratio and gain ratio in case of retirement of partner? Now see, an existing partner may take an exit and cease to be in the business with the existing partners. In this case, the continuing partners would share the share of the future profits and losses in a new ratio, and this new ratio is known as new profit sharing ratio. Easy? Now, what would also happen here is that the continuing partners would now acquire the retiring partner's share also in a certain ratio. Since this is a gain, this is called as gain ratio. How do you calculate it? So gain ratio is equal to new ratio minus old ratio. Simple, isn't it? Okay, now let's see some practical questions that are interviewers' absolute favorites from this topic of partnership. And our question number 18 is the first question in this sequence. The question is, suppose the entire amount payable to a retiring partner is paid in one single installment. How would the journal entry for this look like? Now see, when a partner retires, the firm needs to settle their dues. These dues would include things like their capital balance, that is the money they originally invested in the business, then their share of accumulated profits and their share of goodwill also. The firm here would have two choices. First is to pay all the dues in one go as a lump sum and close their account. And the second choice they would have is pay in installments, which means convert to a loan and pay gradually over the time. Let's see the first case first. If the entire amount due to the retiring partner is paid in one go as a lump sum, what would the journal entry look like in this case? The journal entry would look like this. Something like this, not something like this, it would look like this. With this, what you do is you settle all the dues with the partner, and the partner is now out of the business. You don't owe them anything. The account is fully settled. Now, the second case that may arise here could be the firm is not able to pay the retiring partner's entire amount and wants to pay it in installment. What would happen in this case? In this case, the amount payable is converted into a loan that is to be paid later. The journal entry for this would look like this, which tells us, okay, the retiring partner is still has to be paid. Since the firm can't pay now, the amount is moved from capital account to loan account. The firm will pay this loan over the time. Our question number 19 is, let's suppose you make the partial payment to the retiring partner in cash, while the balance is transferred to the loan account. What would the journal entry be in this case? Okay, so in this case, we debit the capital account to remove the amount we owe to the retiring partner. We credit the bank account because the amount is being paid out. Right away. That is, the cash is going out of the firm's bank. And we credit the loan account because it has to be paid later. So it becomes a loan payable by the firm. Okay, and as you can see, the entry looks like this. Okay, now coming to question number 20. What are the different accounts opened in the books of a partnership firm in case of simple dissolution? Now see, when all the partners of a partnership are solvent and they decide to dissolve their firm, it is called as simple dissolution. The accounts that are opened in the books of a firm in such a case are realization account, partner's capital account, partner's current account, partner's loan account, and cash or bank account. The follow-up question to this could be, what is realization account? So see, realization is the process of converting assets into cash. Assets that are realized are credited and liabilities that are settled are debited to this account. The purpose of this account is to show the profit or loss on realization. So it's a nominal account. While preparing this account, all sundry assets and third-party liabilities are transferred. The account is closed by transferring the gain or loss on realization to the partner's capital or current account in their profit sharing ratios. If you see a debit balance in a realization account, it signifies a loss, while a credit balance signifies a profit. Okay, now let's move on to another important question related to dissolution of partnership, where you need to make some journal entries also. The question is, how are accumulated profits and reserves treated at the time of dissolution of partnership? So see, first of all, what are these accumulated profits and reserves? Accumulated profits and reserves mean undistributed profits. Example, your general reserve, reserve fund, profit and loss account, the credit balance in it. At the time of dissolution, they should be transferred to the partner's capital or partner's current account in their profit sharing ratio. The journal entries in this case would look like this, which shows that you are closing the balances of accumulated profits and reserves, and hence they are debited. At the same time, you are crediting the partner's account to show that this money now belongs to them and will be settled in the final distribution. Okay, if need be, you can just pause the video here and take a good look at this entry. Okay, now the next question, you may find it a little tricky. If all the assets are sold out for cash during the realization state of dissolution, how would the journal entries show up in this case? Okay, so now when a firm sells out its assets, it receives money, which is shown by debiting the cash or bank account, and the journal entry would look like this. Now, there's also a possibility that the certain assets are taken over by a partner. How would the journal entry look in that case? Here, we debit the partner's capital or current account to show that this asset is now a personal property of the partner. The amount is recoverable from their capital. We credit the realization account because the firm no longer owns this asset. It's as if the firm has sold it to the partner, right? Okay, now let's suppose that the partner discharges some liabilities of the firm at this stage of dissolution. How would the journal entries look like in that case? In that case, the journal entries would look like this. Here, you debit the realization account because the firm is relieved from this liability. So, it's like a gain. And you credit the partner's capital or current account. Why? Because the partner is actually paying for them from their personal funds. So, they are entitled to receive that much more from the firm. Okay, now question number 25 is that the partner actively helps with realizing the assets and is paid a commission for his effort. How would the journal entries for this be passed? This one is easier. The journal entries in this case would look like this. You debit the realization account because it's an expense related to the dissolution process. You credit the partner's capital or current account because the partner is entitled to receive this commission. So it's due to them. Okay, now let's say at the time of closing the realization account, if the credit side is more than the debit side or vice versa, what does this mean? Now this is pretty simple. If the credit side is more than the debit side here, clearly it indicates the profit has been made, which should be transferred to all the partners' capital or current account in their profit sharing ratios. The journal entry for this would look like this. While if the case is opposite and the debit is more than the credit side, it means that the firm incurred a loss while settling its assets and liabilities. In this case, the loss is to be borne by the partners. So you debit their capital or current accounts. You credit the realization account to close it off, since we are transferring the loss from realization to the partners. The entry in this case would look like this. Our question number 27 is, how is the current account of the partner closed? Now see, in the fixed capital method, each partner has got two accounts we saw. Capital account that remains fixed unless extra capital is brought in or withdrawn. And the second one is current account that is used for profit, loss, drawings, interest, etc. To close the current account, the balance that is either credit or debit is transferred to the capital account. Let's see the first case. The first case is current account shows credit balance. This means that the partner is entitled to receive that much amount. The journal entry for this would look like this. The second case is that the current account shows debit balance. That's the opposite of the previous one. It means the partner has withdrawn or owes money to the firm. So you see, the journal entry in this case would also get opposite. And we do all of this because at the time of final settlement, especially in dissolution, we want all the amounts to be consolidated into capital account. So we first settle the current account and then finally pay off or adjust the capital account. Okay, so we just saw closing the current account of the partner. The next question could be, and how do you go about closing the capital account of the partner? So if the capital account of the partner shows a debit balance, the partner needs to bring in money to settle his account with the firm. The entry in this case would look like this. The second case is if the cash is paid to the partner to settle the capital account. The entry would be like this. Now see, many a times at the time of such closures, you realize that some assets or liabilities that you're discovering now were never actually recorded in the books. So of course you can't transfer them to the realization account. And your next question could be about handling that type of assets and liabilities. The question could be, if there are some unrecorded assets or liabilities realized or paid at the time of closure, how would you handle them? So see, the question basically is, how would you treat them in the books of accounts now? Let's deal with the assets first. For unrecorded assets that were sold out or realized, they increase the firm's cash and the amount is credited to the realization account because it's part of the dissolution process. And the entry would look like this. If these unrecorded assets are taken over by any partner, in that case, the entry would look like this. Because now that the asset is being taken over by a partner, it means that the partner is becoming personally responsible for it. So we treat it like he's getting a benefit. His capital or current account is debited, and since all of this is a part of dissolution process, it is credited to the realization account. Now coming to the unrecorded liabilities. If a partner pays off such liabilities, the entry would become just the opposite. If the unrecorded liabilities are paid off by the firm, the entry would look like this in that case. If need be, you can pause the video here and take a look at both of these entries again. And finally, let's move on to the last question for today's video. The question is, how is goodwill treated on dissolution of partnership? So see, goodwill can also be treated like any other asset in case of dissolution. If it already appears in the books, it should be transferred to the debit side of the realization account like all other assets. If it is not recorded, it's obvious that you can't transfer it now. However, on sale, the amount that is received can actually be debited to the cash or bank account and credited to the realization account, as we just saw in case of unrecorded assets just a while back. Great. So friends, this is all from my side in this video. If you are preparing for an interview in the accounting role, you must watch our previous video also, which discusses a lot of basic topics that are examiners' favorites. The link is given in the description box below. Take a look. It will be really helpful to you. And if you found today's video useful, do give it a thumbs up and share it with your friends also. And to keep yourself updated with more such videos, make sure that you're subscribed to the channel. I'll see you very soon with a new one. Till then, bye-bye and take care.